The next transaction to process is an unusual one. We've received interest from the bank, $800. Interest received from the bank is revenue. So our cash assets have been increased by this amount. So on the debit side of bank, we write the date and we can write interest revenue, $800. So we debit the bank account to increase it, $800. And interest revenue is a revenue, and to increase revenue accounts, the double entry accounting rules say you make a credit entry, so we write bank and here $800. So the value of the debit, $800, equals the value of the credit, $800. This next transaction is paying advertising expense, $990, and that includes $90 GST. This is going to impact on the bank account, the advertising account and the GST clearing account. So if you make a payment, which it's going to reduce your bank, reduce your cash assets. So that means a credit entry to the bank, and you write advertising and the amount's $900, and you write GST clearing $90. You could put that on the same line if you wanted, if you had enough space. So there's two credits there, $990, and those two credits are matched by the two debits. One is to advertising. We're going to increase the expense. Double entry accounting rules say to increase an expense, it is a debit. So you debit that $900. And because you made a payment of GST, that reduces the GST liability. So a debit entry into the GST clearing account, cross-references bank, the amount was $90. So there's two debits, one to GST clearing to reduce the liability, one to advertising, $900 to recognise the expense, and those two debits equal these two credits to the bank account, advertising $900, GST clearing $90. The total value of the debits equals the total value of the credits for every transaction. Now this next transaction would be regarded as difficult. It is the sale of stock, including the impact of GST. So we had a cash sale of $7,700, that includes GST. Let's do that part first. Well, if cash comes in, that means your bank account must increase. So we debit the bank account and we write sales, and the amount was $7,000 for the sales, but there was also an inflow due to GST. Cross-reference GST clearing, the amount $700. So there you go. Debit bank $7,700, made up of two entries there. You could put that on one line if you had enough space, and that's matched by two credits. So one goes to sales, so we go to the credit side of sales. We put the date, we write bank, the value was $7,000. There it is, that increases revenue. Double entry rules say to increase revenue, you make a credit entry. And we go to GST clearing, and this is a liability account. And if we have received GST from our customers, that increases the liability. So we credit that account $700. So there it is, $700. And there's the other part of the entry, $7,000 to the sales account. And those two credits equal these two debits. So $7,700 in total debits equals $7,000 plus $700 total credits. The total value of the debits equals the total value of the credits. But we haven't finished yet, because we have to record the cost of sales or cost of stock, $2,800. This is the cost price of the stock that's now gone. That means we have less stock on hand. Let's just change the name of that account to stock control. And we're going to reduce the stock asset by a credit entry. So we're going to write the dates, 6/5. We're going to write cost of sales, which is $2,800. We've made a credit entry there in the stock account. It's an asset. A credit entry reduces the asset as per double entry accounting rules, and that is matched by a debit to cost of sales. It is an expense. Expenses go up by debit. So debit cost of sales, cross-reference stock control, $2,800. So there's the debit, $2,800. That's to the expense account. There's the credit, $2,800 to the asset account. Total value of the credits equal total value of the debits. So that one transaction on the screen now, that would be regarded as a difficult transaction. So if you could process that data, that means you're pretty good at this stage of accommodating double entry accounting.